I graduated college and I got a summer job to clerk on the floor of the New York Stock Exchange before I went off to business school. And so it's 1971, and I'm following the markets. And there's this question about the dollar and the question about gold and these issues that started to emerge. And there's something called a balance of payments problem. And I'm looking at this, but this stuff never happened before. And the President Nixon, on August 15th, 1971, gets on the television. And despite claims that they'd never devalued the dollar, they float the dollar.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold.
And so the dollar sinks, and he describes that. And I walk on the floor of the New York Stock Exchange the next morning. What does that mean? I don't know what it means. It means like the definition of money is different. I would have thought maybe it's a crisis, but the stock market goes up a lot. Then in 1973, sets the ingredients up for the first oil shock. Well, we never had an oil shock before, and we never had an inflation to worry about before. And all of those things became, in a sense, surprises, and I developed a modus operandi to expect surprises.
I think the origination of the concept, it was actually not a concept, the origination was a question. And the question, I would say, it was in kind of like 1988, 89. Right in there. Ray asked the question, gee, I wonder what kind of investment portfolio you would hold that would perform well across all environments.
I know that there are good and bad environments for all asset classes. And I know that in one's lifetime, it's almost inevitable that there will be a ruinous environment for one of those asset classes or one of our portfolio that's dominated by one of those asset classes. That's been true throughout history. A lot of people think that if you have diversification, it's going to mean that you're going to give up return. And that's really a silly paradigm, because it only means that when you're looking at that, you're looking from a frame of reference in which equities have a higher return than bonds, not after you have risk adjusted them so that they have comparable risk, because roughly speaking, comparable risk assets have comparable returns over a period of time.
I was messing around one day. So I just got a bunch of return streams, stocks, bonds, commodities, inflation index bonds, and so forth, stuck them in the spreadsheet. When I looked at those, I said, oh, that's interesting. Those are like half inflation and half deflation. So I grabbed Ray and I said, hey, Ray, look at this. This is interesting. I did this little thing, and you look at it, and what it shows here is that the best portfolio would have had a balance between inflation and deflation. And he goes, yeah, well, that makes sense. And he goes, but, it really should go beyond that. It should really also be balanced to growth.
So I imagine 4 portfolios with an equal amount of risk in them. That means that I would not have an exposure to any particular environment.
You've got growth and you've got inflation, and pretty much I think that's all you really need to worry about. And then you've got assets that do well in the rising and assets that do well in the falling. That basic concept is the building block.
So how do you create an optimal strategic asset allocation mix that's true of time? I went back literally hundreds of years and in all different environments, and I looked at how that balanced portfolio operated through those environments.
Real assets, rebalancing, went through all the things you need to go through to create a real portfolio.
It's like inventing a plane that has never flown before, and you look at that and you say, boy, that sure looks right, and we've stress tested every which way. And then we run a pilot. Does it fly like we expected that it would fly?
He started thinking more about his trust and so forth. And so he created a real portfolio, and bam, that was his assets, and it was somebody's part-time job to watch over that and rebalance it once a quarter.
I did that for my own personal trust money. I'm thinking about the next generation when I'm dead and gone. What would I want their portfolio to be in?
Never was there ever going to be a product called All Weather. And then around maybe 2003 or 2002, I'm sitting on my sofa at home, and Britt calls. I said, Britt, look, you're trying to make a 10% return. Let me tell you what I would do if I was in your shoes. You start off, you've got the yield on cash. I would overlay on top of cash. I'd overlay some bonds. And then I'd overlay on top of that some credit spreads because they're negatively correlated to the bonds. They operate with the economic environment differently. As you overlay these return streams on top of each other, that will get you up to about an 8% return. And then you're going to need about 2% from alpha. So I put together this, presentation basically showing him how that would work. That was the first institutional all-weather account. The basic root is that the world can be understood. I think that's the basic premise that it starts from. That the world can be understood in terms of the cause-effect linkages as a machine.
At the same time, I think that there's a way of looking at things in which people overly complicate things, perhaps in a desire to be overly precise, and can easily lose sight of the important basic ingredients that are making those things up. And so I watch people in asset allocation put things in a Markowitz portfolio optimizer without saying, stop a second and let's just take those parts. What are those basic simple parts? What is going on in that optimizer? What is going on with the asset classes to make up that result? And let's just relook at it in that basic simple way.
All weather is a very simple approach that's very powerful. Today, it's a very cool thing to be able to say that today we can structure a portfolio that will perform well in the year 2022. Even though we have no idea, can't possibly know what the world would be like in the year 2022, but we can structure a portfolio today that we can be pretty highly confident we'll have a pretty good year in the year 2022. That's a really cool thing. It's an elegant solution, right?